Beating the market, something every investor dreams of, but most people fail to actually accomplish. There are some wizards, however, that have achieved this and made ridiculous amounts of money in the process. The wizard I'm talking about today goes by many names: Diamond Hands, Roaring Kitty, and my personal favorite, Deep Fucking Value. Regardless of what you call him, he was the face of the legendary GameStop short squeeze and had one of the most insane trades I've ever seen from a retail trader. With a net worth of around $90,000, he invested $53,000 into GameStop Leap call options and made an astounding $48 million dollars. I literally can't even fathom that. But being the gambling retail degenerate that I am, I scoured the internet and watched some of his videos to figure out how. And that's when I came across deep value investing. So the idea behind deep value investing is that you're looking at stocks that most other people aren't. They're priced extremely low or even for bankruptcy. But if the company manages to avoid it for whatever reason, the price can rise by 15 to 20 fold very quickly. And he almost exclusively looks at bad companies. Most of his trades were turnarounds or cyclicals. I know this sounds crazy, but he shoots for 50 to 100% year over year returns and has actually accomplished this on numerous occasions. He was crushing the market before GameStop even happened. So now that we got all that boring stuff out of the way, let's get into the framework that DFV used to make some money. So he starts by looking at the small cap holdings of these companies on Whale Wisdom. Typically, he looks at companies with a market cap lower than $5 billion, dollars, so you can just use Whale Wisdom Stock Screener to look for all the companies below that market cap and that are also held by the funds on that list. He tends to have the most overlap with the small market cap holdings of Greenlight Capital, which now on Whale Wisdom is DME Capital, and also Scion Asset Management, which is Michael Burry's company. And he likes any of these people or funds to have a 5% stake or more in a company because that suggests a deeper involvement in the company aside from just purchasing the shares. If you ever find yourself doing research and come across a fund you're unfamiliar with, look at their holdings because if they have like 15 to 20 positions, that most likely means they've done a deeper level of research than a company that has like 1,000 holdings. But once he has this list of funds, he uses OpenInsider.com and looks for clustered insider buying by prominent executives. And he specifically mentioned like CEO, CFO, chairman of the board in one of his videos. But ideally, this buying is within the last 6 months. The more recent, the better. And for anyone who knows Peter Lynch has probably already heard this, but a famous quote from him is that insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise. With that being said, he weighs insider buying very heavily, especially during market sell-offs. He's said in one of his videos, 3 to 4 insiders is good, 5 is a lot better, and $200,000 to $300,000 is good, but again, 500K is a lot better. So you can use those metrics when looking at insider buying. He also likes when respectable active investors are actively buying, although it's not a must. But take Carl Icahn, for example. I remember watching one of DFV's videos, and he just saw a bunch of Carl Icahn green on the screen. And he was immediately intrigued and started to check out the company. But those three things alone, the percentage owned greater than 5%, the market cap below $5 billion, and insider buying, will often result in stock being added to his watch list. He buys leap call options, which basically just means that he buys options that don't expire for more than a year out. And his typical holding period is anywhere from 3 to 24 months. But he specifically likes companies with overblown bankruptcy risk. And he himself has stated, if none of the companies you invest in go bankrupt, you aren't taking enough risk. So what is his buy criteria once he finds a stock he's interested in? To start, he likes a significant discount via any of these multiples. I'd say price to book and EV to EBITDA would be the first ones to look at. I've seen him talk about price to book in a handful of his videos, and EV to EBITDA is also Michael Burry's main filter when screening for undervalued stocks, which again is someone he holds in high regard. If you don't know what either of those are, I'll link an Investopedia article in the description for what they are and what they mean. But for price to book, you can just find it in the Whale Wisdom scanner and put a max value of 0.7. And for EV to EBITDA, figure out the average EV to EBITDA for whatever sector the stock is in. And if it's below that number by a significant margin, then that means it's at a good discount. So for example, let's just say the finance sector has an average EV to EBITDA of 20, But you find a finance company that has an EV to EBITDA of like 9 or 10. That means it's at a pretty significant discount. It's an outlier. There's nothing else in the finance sector that's really close to that. And we talked about this earlier, but the next thing that he likes to see is just the overlap with the renowned investors. So, Scion, Greenlight, Icon, etc. The next thing that he likes to see is positive free cash flow. This one is massively important. Most of the companies he sifts through are doing so bad that they don't have this. But when he finds one that does have a significant discount and positive free cash flow, he gives it a deep dive. And GameStop was a perfect example of this. The next one is something that, again, I kind of glossed over earlier, but he also likes to look at market cap size. He'll buy any size company, but his preferred range is a market cap between 200 million and 5 billion. And his reasoning behind this is that companies in this range are sized so that 1 to 2 firms max can take a significant stake. But if price begins to move, more firms can pile in. This range is also where the most mispricings can occur, so it works out in our favor. The next one is really important: balance sheet, bond prices, and credit risk. I know they're kind of all packed into one, but again, really important. In one of his videos, he actually specifically calls out credit risk and bonds as a core part of his analysis. And when you're sifting through all these trash companies, you got to try to figure out what the probability of this company going bankrupt in the near term is. And to do this, you really can just look up like ticker symbol credit risk on Google, and you'll be able to find all the info you need. I know I keep repeating myself here, but the next one is, again, massively important. And, if they weren't massively important, they probably wouldn't be on this list. But there needs to be a path to positive investor sentiment. Even if a stock is technically, quote unquote, undervalued, that doesn't mean it'll just go up. It can stay at the same price or even go lower if there's no clear path. And DFV has also famously stated that you can't even get an accurate, precise value of a stock. And even if you could somehow, no one cares. The market will do what it wants. So there needs to be some kind of catalyst, stabilizing revenue, active investors, etc. An analogy that he gives that I really like is that a company needs levers to pull. If they got some levers to pull and some tricks up their sleeve, they might not rebound to all-time highs, but they might be able to turn around for a quick profit. Next on the list, stable gross margins. He consistently looks for this, and he still dabbles in companies with bad or declining gross margins, but his conviction in the stock is heavily influenced by this metric, and this was another large factor in his GameStop play, and you can even see him talk about it in one of his YouTube videos. And I know some people might be turned off by this next one, but he likes to use technical analysis. He'll look at the chart to get a better idea of the overall sentiment, but he also uses simple support and resistance lines to help time his entries. And if you've ever watched his live streams or watched any of his YouTube videos, you'll see he looks at tons and tons of articles, seeing people's thoughts, the general consensus around stocks. But specifically, Jeremy Blum from Seeking Alpha is someone he takes very seriously. So now that we've gotten all the buy criteria out of the way, what are some things he doesn't care about? Discounted cash flow models and precise valuations. Like I said earlier, he believes you can't even get a precise value anyway, so it really doesn't matter. But just figure out a quick range and figure out an undeniable outlier, kind of like what I told you with the EV to EBITDA earlier. Another thing he doesn't care about is PE ratios. When a company's earnings are declining and bankruptcy is a real possibility, PE really isn't going to do anything for you. But the last thing on this list is short interest. It's usually irrelevant, but if it's really high, it's a turnoff. But even then, he stayed in GME through 100% short interest because he had such a deep knowledge and understanding of the company. So I would definitely watch some of his videos and maybe even go through his Reddit posts, not only to learn even more about his approach, but you might even get a better idea of the kind of person he is and potentially his thought process. You'll see he's very laid back and fluid, and he may not follow this list to an absolute T every single time, and sometimes he might add something or do something different, but this is his general framework. But before I end this video, let me say shout out to Not Your Average Bull 71 on Reddit. His post was like a holy grail for me, and it was damn near the entire script for this video. But also shout out to the Super Spy on Reddit. He recreated Roaring Kitty's spreadsheets, and if you've ever seen his videos or his live streams, his spreadsheets are no joke. but they're really, really helpful. So I'm going to link uh, both of their posts. And shout out to Benjamin. He made a deep value investing video that I also used. Shout out to Roaring Kitty for, everything that he's done. I used some of his videos, and I'll link some things that I think are helpful. But I hope you've enjoyed, and I hope you have learned something.